walk us through a scenario in terms of storing money and tax advantages.
I could break it down pretty simple for people. So to understand that, you need to understand two types of life insurance. So I got to think of my left fist and my right fist, right? So on one hand, this is life insurance 101. And so you can know how to think about life insurance and how you can use it for other assets. There's two categories of life insurance. One of them is called term. Term means a period of time. So like if you get a 30-year mortgage, that's a 30-year term you got, right? It just means a period of time. So term life insurance, it mostly pays when a person dies. There's some that can pay if you get sick or hurt. So when most people think of life insurance, they think about the dying part, which equates to term. Now, one's not better, one category is not better than the other. I own both of them. I use them for different purpose. So you got term life insurance, how most people think of life insurance. And then you got permanent life insurance. Permanent means it lasts for your entire lifetime. So you'll be there for your entire lifetime. There's different types of permanent life insurance, but that's the main thing. So permanent life insurance also pays out when a person dies, all those features, all of that in there. But it has a second feature, which is inside of your life insurance policy, it has a cash value. This cash, you can put money into your life insurance policy, just like you can put money into your bank. You can store money in different places. You can store money in the bank, you can store money in Wall Street, you can store money in real estate, you can store money in your mattress. Some of us store money inside of our life insurance policies and then use that to buy real estate. And the reason for that is I can earn a higher interest rate inside of my life insurance policy than I would get at the bank. And my money is protected from losses. So I can store this money inside of my policy, get a higher interest rate, and then the insurance industry has a very, very cool feature where my money's compounding, right? Compounding means you're getting interest on top of interest. It's building on top of itself. So if my money's compounding and it's building, it's earning me interest, I never want to take it out. I wanted to keep building, and it's like a snowball that just keeps getting bigger and bigger, like an avalanche going down a mountain, getting bigger and bigger. So I never want to take that money out. So how do I buy real estate? How do I buy a business? How do I do these other things and keep my money compounding at the same time? Because rich people want to do both. I want to do both. So the insurance industry allows you to leverage your policy, which means you can take a loan against your cash in the policy and keep your money. Your money stays in the policy, continues earning interest. You borrow against it. Now you go buy the real estate. So now we've got cash inside of your policy. You can then go and it's like, okay, just like if I got equity in my house, I want a home equity line of credit. Essentially, it's the same thing. I got equity in my life insurance policy. That is cash that belongs to me and it's compounding. So I can go, instead of taking it out, I go and take a loan against it. So now I got money that's in my policy that I borrow against to put inside of an asset. So a real life example of this is, I have a client, he's been funding his policy for I think 2-3 years. The guy saw an apartment complex in an opportunity zone. So he said, okay, I want to leverage the policy to buy this asset in the opportunity zone. So we went and we looked in his policy, then we took a loan against his policy. In a few days, the money's wired to his bank account. When you take a loan against your cash in your life insurance policy, there's no credit checks, there's no income checks, there's none of that. And you don't have to pay the loan back on a set schedule. You can control how you do that. So this particular client, it's an awesome feature. It's probably your best loan you can take in America. He takes a loan against the cash in his policy. Now his money stays in the policy, continues to earn interest. His money hasn't left the policy. He simply used it as collateral for a loan. He takes the money he receives, he puts that towards the apartment building in the opportunity zones. He buys that. So now, as we know, opportunity zones create tax advantages. And his life insurance policy, as the money is growing in his life insurance policy, there's no taxes on that. And then when he takes a loan against it, because his loan is not income, there's no taxes to him. So he can access this money without paying any taxes, put it in an opportunity zone and get tax advantages on having that money inside of the opportunity zone. So that's what we did in that scenario with this client. The leverage policies, no taxes on any of his stuff, no taxes on his growth, and he's leveraging it. If the client dies, he still leaves a tax-free death benefit to his beneficiaries, and he leaves them the real estate.